In our previous video, we talked about how to account for an exchange of non-monetary assets. And the rule that we followed, we just said that we're going to record an asset received at its fair market value and recognize a gain or a loss, provided that the transaction has commercial substance and that we can determine the fair market value and that it's not some kind of exchange to facilitate a sale to customers, right? However, in the example that we just had a situation where there was a gain, right? So there was a gain being recognized. And so in this video, I just want to walk through another example where I changed some of the numbers up a bit and we actually look where we have a loss. So let's say that we have Thompson Trucking and they give a delivery truck to Tito's Waste Management, okay? And Tito's Waste Management is in turn going to give a dump truck to Thompson, right? So it's a truck for a truck, and there's no cash changing hands here. It's just strictly a truck for a truck. So Thompson, the truck that they give to Tito, has a fair market value of $4,250, an original cost of $22,000, and $18,000 in accumulated depreciation up to this point. Okay? I just want to show you the journal entries that we would have then from Thompson's perspective, right? So Thompson is getting a dump truck with a fair market value of $4,250, right? So it's going to debit that, and then it's going to debit the accumulated depreciation for $18,000 to get that off the books, right? That's the depreciation associated with the delivery truck that it's getting rid of, which it will also credit for its original cost of $22,000. And then there's going to be a plug. There's going to be a plug to make these entries balance. There's going to be a credit, and that'll be a gain on the exchange for Thompson. But let's look from Tito's perspective. So Tito is getting a delivery truck, and the delivery truck it's receiving is going to have fair market value of $4,250, right? So each truck has the same fair market value we're saying here. So Tito debits delivery truck for $4,250. Now, Tito, they're getting rid of a truck too. Remember, they're getting rid of a dump truck, and that has an original cost of $67,000. So they're going to credit dump truck for $67,000, and they have to get rid of the depreciation associated with that dump truck, which let's say was $58,000. So there's going to be a debit to accumulated depreciation to zero out that account as it relates to the dump truck that they're getting rid of. Now, notice something. We've got $67,000 in credits, and we've got $62,250 in debits for Tito. So what is going on here? Well, we have more credits than debits, so we're going to have a plug. We're going to have a debit to make this balance, and that's going to be $4,750. That's going to be called, let's call it loss on exchange. So that'll go to the income statement. Again, this is provided that this transaction has commercial substance, and I'm going to make another video where we talk about transactions that don't have commercial substance. But if you think about this, from Tito's perspective, why we have this loss, basically Tito is getting something with a fair market value of what is being received is $4,250, right? That's the fair market value of the truck that Tito is getting. The book value of what Tito is giving up, right? So what is being given up, that's going to be that $67,000 minus the $58,000, right? So $67,000 minus $58,000 is $9,000. So Tito is getting something with a fair market value of $4,250, but giving up something with a book value of $9,000. And so if you subtract the book value from the fair market value, you actually get a negative number, negative $4,750, and that is the loss on the exchange.